5 million, 2 million, 100 million, 1.2 million. Every startup seems like they are raising capital for their startup, but there's a huge misunderstanding among early stage entrepreneurs about equity, convertible notes, and the fundraising process. My name is Christian Peverelli. This is Behind the Movement, where we talk about entrepreneurship for non-technical founders. And in this episode, we're gonna jump into funding, fundraising, whatever you wanna call it, 101. Let's go. Now, the first big disclaimer that I wanted to bring to you is that fundraising is not for every startup. And the most important thing at this stage, if you're a founder or if you're an aspiring founder looking to build a company, is to understand the basics around equity, convertible notes, fundraising rounds, and everything that involves the fundraising process. Investors is one route to go. There are also many alternative funding routes that you can take. In fact, there are a huge number of financing mechanisms that you can use as a startup founder. So let's do it. My aim with this video is to make you the best CFO in the world. That is a complete lie. Yeah, that's just a lie. But no, I really want you to understand the basics so that you can go out there and make the right decisions for you. So first of all, what is equity in a company? So equity can also be thought of as shares in a company or ownership of a company. First of all, there are different types of shares, but for the sake of this, we are just simply going to talk about common stock. So I'm sure you know this. If you have shares in a company, there are two main things in which you have an influence. The first one is ownership. So what do you do with the profit or the loss at the end of the year of the company? You will have a say proportional to your stake in the company. So if you have 10% of the shares, you will have potentially 10% of the votes in this case where we are talking about common shares. Again, there are different types of shares, but usually for the early stages, we're talking about common stock. The second thing is voting rights. So decision-making rights within the company as well. For example, who is the board of directors of the company? That is the people who are operating the business. What proportion of the profits of the company at the end of the year are we going to reinvest in the company to help it grow? And what portion of that are we going to give to the investors, the owners of the company? So this is anyone who has shares in the company. It could be a founder, it can be an investor, it could be an employee. And so when we give a portion of the profits to the owners, that's called dividends. And it's usually paid on an annual basis. Excellent. Now, what is fundraising? What is the mechanism of fundraising? Usually when you start off a company, you are going to have a determined number of shares. That number is very large because you can't necessarily split shares in half. And we can talk about that in another video. But for the moment, I really wanted to explain to you what's happening when we are fundraising. So let's say that a company has 100 shares in it. Usually we're more talking about, maybe let's say 1 million shares or 100,000 shares. But let's say that one has 100 just for the sake of this math. So you have 100 shares in a company. What happens when you want to fundraise? So when we're fundraising, we're actually going to be creating new shares to sell to that shareholder. So for example, if there are 100 shares in the company and we create 20 new shares in the company, then after that takes place, the investment round takes place, then you will have 120 shares in the company as a whole. Now that is obviously what happens most of the time. Sometimes people who already have shares can sell their shares to other people. We won't cover that now, but it's important to understand. So I'm sure one of your questions right now is saying, well, wait, if I have, let's say 10 shares in a company that has 100 shares, and then we add an additional 20 shares, don't I have a smaller percentage of shares overall? So I only have 10 shares out of 120 instead of 10 shares out of 100, which is 10%? The answer to that is you're right. That being said, when the actual money comes into the company, your company is going to be worth more than before. And usually you're agreeing on a value or a valuation for the company before that money is being put in. And so this valuation, there are several ways to calculate it. I'll talk to you about it in just a second. But let's go back to your other question. Yes, you will own a smaller percentage of the company, but you will be owning a smaller percentage of a larger pie. And so you are trying to get the value that you have within the company. Let's say you invested $100,000 to multiply over several subsequent rounds of funding because there are going to be higher and higher valuations as you grow. So the value of the entire pie gets much larger. Even if you own a smaller percentage of it, you own a lot more value. And a quote I love is 100% of $0 is zero. If you own 1% of a $10 billion company, that's a lot of money. And so when you're fundraising, you are selling a piece of your company, a piece of the equity of your company. And usually a lot of the employees who you have on board early on have shares in the company as well, are also owners. And so will have a say in both the decision-making process, but also how capital is distributed. So now let's talk about the basics of valuation, because this is something that's really misunderstood within the industry. Basically, over the past 50 years, we've been building startups in Silicon Valley, high growth startups that are very difficult to come up with a valuation for, because even though it might just be very early stage, what we're really betting on is not the current revenue that that company is making, but the potential for future revenue. In the past, we had several ways of calculating valuations that essentially don't really work for the tech industry or for high growth potential startups. Before, we used to use methods like the discounted cash flow, where we would essentially say how much we expected it to grow, and we already had previous numbers of how much it has grown till now. And then we could basically say, okay, great, what is the present value of future returns or future return on investment? And so this was heavily guided by generating revenue. Another way that this used to be done was 5 times the EBITDA, which is the earning before interest and taxes, appreciation, depreciation, basically all the revenue minus all the costs. And you multiply that figure by 5 and it's roughly the value of the company. Now again, the supposition there is that you are already generating revenue. And as you can imagine, for high-tech startups where you're at this point potentially just trying to launch your product in the market and get first paying customers, it's difficult to judge the valuation right now. And that's what really brought a rise to convertible notes, safe notes, something that we're going to talk about right now. But overall, as a tech startup, you're judged by future potential over current revenue. And that's super important to understand. So now let's talk about convertible notes and safe notes. These are relatively similar, but essentially they are very different from what we call a priced round, where you agree on the valuation of the company and then you issue the number of shares to be able to get the percentage based on the investment. It is very clear calculation and it is easy to do. So what's a convertible note or a safe note, which is very similar? What they are really just financial instruments. They're a way to invest into startups. And they're a way more specifically that's being used over and over in Silicon Valley, specifically for early stage startups versus later stage startups. Because classically, the way that we do it is that we agree on a valuation, and then let's say this person wants to buy X percentage of, or wants to invest X amount of money in, we can make a calculation that basically breaks down how many shares we have to issue to that investor. How many new shares do we have to create to give to him for his investment or her investment? And so one of the big benefits of using a convertible note or a safe note early on is that you do not have to agree on the exact valuation when both parties are really just guessing, right? That's a great quote, is basically like all about the fact that when you create a financial forecast, the one thing investors know is that you're completely wrong. And so it's more about making it credible than actually making it right when you see the way things play off when people actually grow out these companies. But anyway, you don't have to agree on a valuation until your shares actually convert. So all that this sort of agreement says is that we will be issuing new shares at a discounted price on the next round of investment that is going to usually be a priced round. So that usually will be for your Series Seed or potentially for your Series A. Both of those are stages of investment. And so when you're seeking investment, a convertible or safe note just really makes it much easier for both parties to agree on investment and to get the money in the bank quicker. And so just a side note, there is usually a period between we agree on investing and the money actually hitting the bank. So you have to calculate for that. But in between, the process of doing that with a convertible note or a safe note is way quicker than the process that it takes to do that for a priced round. So that's another huge benefit of going for these investment vehicles early on. And that's why places like Y Combinator, Techstars, 500 Startups all work with this model. And when we talk about valuations, there is one concept that's important to understand, that there is a pre-money valuation and there is a post-money valuation. So basically, when we talk about the value of a company, there's going to be the value that we agree that this company is worth, and then there is the investment. And so this is how much the company is worth. This is the investment that's coming in. There is a pre-money valuation before the money goes in. And then after the transaction takes place, there is a post-money valuation. And that's when the money essentially that was invested in it is calculated as part of the valuation. So essentially it is the value of the company that you agreed on plus the money that was put in, because of course the value of the company is higher when you have more money in the company. And so when you have that conversation with investors, make sure you know the difference between those two things. The reason why it's important to understand some of these things basically is because there are so many different types of investors. Like if you choose your family member to invest, let's say $5,000, $10,000 in your startup, which usually is the case for early stage startups, they have to go for that kind of financing, FFF, which is essentially family and friends. So that person might not understand the difference and don't understand why they would invest, to get 5% of a company that currently doesn't generate any revenue. So understanding those mechanisms and explaining it, depending on who is investing in your company, if they don't understand it, will really save you a lot of time, specifically when you are talking to traditional investors who might invest in real estate, they might invest in e-commerce startups, they might invest in the stock market, they might invest in companies that are already generating revenue and have been part of like an acquisition. So all those mechanisms are very different from what you have in the tech industry. So understand when you start these conversations to make sure that people kind of understand. I've seen this often where there's a misunderstanding and then there's a huge conversation around the valuation, which is essentially what we're avoiding when we go for convertible notes and safe notes. So I guess the conclusion to all of this is that you have to understand that each profile of investor is going to be completely different. And then in many cases, you might have to actually explain the process out to people when you're taking money from them because they will not understand. And subsequently, what happens if you haven't done that is that you get early stage investors who are totally disconnected with what you're trying to do in terms of vision. And when you raise money from institutional investors, whether those be venture capital funds, angel investors, or maybe an angel syndicate, there is not going to be as much of the friction to make the deal happen. Because remember, everyone who is an owner in your company will have a say. And over time, that can become more and more complicated. So anyway, I hope that I broke this down clearly. If you'd like to learn more about fundraising, you can check out our interviews. I've talked to several investors there who give their point of view about no code, about building startups, about fundraising. But you can also, if you'd like to get started, join our program at We Are No Code. It's called the No Code Startup, and we help people build companies leveraging no code platforms as non-technical founders. If you like this video, please do me a favor and smash the like button, subscribe, send it to a friend, and to reward you for that, here's an awesome cat video. We'll see you in the next video. Thanks for joining.